Hey everybody, Kevin coming to you with Weeds Weekly Wrap. Once again, what we cover very quickly is what happened last week in the mortgage industry, what we can anticipate coming up this week. We do have our big Fed meeting this week on Wednesday, and then just some random thoughts. And I like to discuss a little bit some worldwide conflict, right? With this past weekend of what's going on over there in Iran and with our U.S. warships and everything like that. How could that potentially affect our market? So first, let's just cap off. Look, as we come to the end of January, what we're really seeing is traders are hedging of what the Fed is going to do and when they're going to do it, right? I think we can all be in agreement that this year in 2024, we are going to see a decrease in the Fed funds rate. But what's really weighing heavy on every trader's mind, and obviously people that are looking to buy and sell houses, is, hey, when is this going to happen and how often is it going to happen this year? And what we saw in January was a lot of just posturing, a very conservative approach. And the result has been interest rates creeping up little by little by little each and every week. Now, like I said last week, I don't think we're going to see any drastic moves in one direction or another throughout all of 2024. I think it's going to remain fairly steady between 6.25 and 6.75. We may even get down to about 6 1/8. Luckily, 6% if we can. But I'm talking about the averages. I'm talking about the people with the best credit, people with the worst credit. I'm talking about the law of averages, right? And that's what we really have seen so far this year. That's been the overall glaring theme. However, we are coming into the months of February and March, and I'm going to discuss quickly further on in the video why I think that's fairly significant. I really, truly believe that these next 6 weeks paint the picture for what we can expect in 2024. But let's go back to the last week. What we're seeing is possibly that the Fed and what they've done with the Fed funds rate is really starting to work. What we saw with PCE, the price index this past week, is that the core inflationary number is coming under control. It seems like the Fed rate increases, the 11 that we had, the quick approach that the Fed had, keeping them high now longer than a lot of people anticipated at this point, it's really starting to work in the Fed's favor. It looks like, although inflation is still high, the consumer is still battling with it from an affordability standpoint, but it appears that the numbers are starting to trend down, and that's a great sign for the Fed. However, the things that are pushing back on that is, once again, the damn consumer. The consumer strikes again. It's almost like, right, it's the return of the Jedi, the whole Star Wars theory. I can't get it out of my head. And the resiliency of this consumer with inflation staring them in the face. You have credit card debt astronomically up, a lot of uncertainty swirling, but hey, a lot of just pent up demand from the pandemic just has that consumer still plugging away. And the result was a GDP number for Q4 that blew away forecast. The forecast was anticipating a 2% increase, and it came off at 3.3%. That is a huge number. That means that the economy is healthy, the consumer is spending, and things seem to be chugging along, right? We're not going into some type of recession. So those recession fears are really almost on the back burner at this point based on that number. However, let's look at the week ahead coming on now, right? Because this is really the week that everyone's been looking at. And it's an interesting week because you have our first Fed funds meeting of the year. And are they going to be dovish? Are they going to continue to be a little bit more hawkish? And I'm going to lean on the later side. They're going to be more hawkish in their language. They're going to say that some things are obviously moving in their favor. They see softening here in the inflation, although jobs are still a concern. But overall, I think they're going to give a hawkish theme in that they are going to remain data dependent. And I think they're going to point out, once again, as I said earlier, these next 6 weeks that I think are going to be very critical, because remember, their next meeting is in March. And I still believe there's now, and what everyone's experiencing, there's a 50-50 shot of what the Fed will do if they were actually decrease the Fed funds rate at that point. However, if we see jobs skyrocket, I've said it once and I'll say it again, the Fed may have to lean on the fact that maybe they didn't quite do enough, right? But I think that's way on the lower scale right now. But again, the Fed is meeting this week, and I think from a real estate perspective, we already kind of can anticipate what they're going to say. They're going to have much more of the same message. We're dependent on data. It's really unclear. We need consecutive months before we're going to make any adjustment to the Fed funds rate. So I don't think the language is the big number this week. What's significant about this week is it falls on the first Friday of the month. And we got several jobs report. We got the JOLTS report. We got the non-farm payrolls report at the first Friday of every month. That's Friday. To me, that is the bigger number this week that has the potential to move the treasury market. I think the Fed is just kind of a wash. No fireworks, steady as we go. Everyone's now already looking forward. Again, markets are always forward thinking to March and thereafter. Those future meetings, we're already writing this one off. It's a check. They're not going to do a damn thing, right? It's just how are they going to change their language? So I've already discussed, I think the bigger number for the weeks are these job numbers. And I think if we get a number that just blows away forecast, I think the Fed is really going to have to be concerned with, hey, jobs creates wealth, wealth creates more money, money in the marketplace chasing fewer goods becomes an inflationary problem, right? And I think the Fed really needs to see unemployment numbers increase to know that businesses are going to scale back a little bit on spending, and therefore it's going to basically create that soft landing that they're looking for. The other things that were actually positive this past week as well is, we've already said last week that we had those lockbox numbers. And I guess the biggest thing I'm trying to point out is 2023 created a lot of constraint in our marketplace. And as we're moving into 2024, I think we're seeing a lot more activity. I'm hearing it from agents. I'm seeing it with open houses. It seems like the consumer, now that the interest rates have come down, I think there's a little bit more certainty with where interest rates are going to kind of land, although they could bounce around a little bit, but we're not going to be back up to the 8%. And what we saw is there is a lot of pent up demand. We had all those lockbox openings that we talked about this last week. And then the other thing that we had is we have this pending home sales index. Pending home sales index obviously shows what are the numbers and what's kind of the demand that's out there for pending home sales. And what we're seeing is a trend that number is scaling up. So you're seeing pending home sales numbers on the uprise, which means that there is pent up demand. We're seeing it in the marketplace. And that's a great thing as we head into 2024, because as we recall, the numbers for 2023 were some of the worst that we've had in decades as far as home sales. So the good news for the real estate market is I think we're going to find more stability as we head into 2024, although we do have the uncertainty of obviously, the election and exactly what the Fed is going to do. But I think the ceiling's been established, and that's a great thing as we move forward. I've already said it once, I'm going to say it again. To me, the next 6 weeks are going to paint the picture for 2024. All the numbers that we have recently seen come out over the last 3 weeks, or mainly in January, were all reflective of last year. They were reflective of December. They were the GDP for the Q4. It was a lot of information, a lot of numbers where anyone who's been listening, we already anticipate that those numbers were going to be higher than anticipated due to the resiliency of the consumer. We already anticipated that the consumer cannot help themselves but spend, especially during the holidays, especially when Santa is talking about all these wonderful things he's going to do for everybody. So we anticipated that. These next 6 weeks are going to give us data from January. It's going to give us data from February, and it's going to give us the beginning information, just like we're getting this week, of the JOLTS and the jobs numbers and the non-farm payrolls in the month of March. And then we have the next Fed meeting. So to me, these next 6 weeks are really going to set the stage for what we can anticipate in 2024, because I think the big market movers come in Q2 and Q3, right? Remember, we have an election. An election sitting on the horizon. Elections create uncertainty for a lot of traders, a lot of people in the stock market, and a lot of people in real estate. They just kind of want to take a pause and see what's going to happen. What is the policy going to be? How is that going to affect them, their pocketbooks, their lifestyle? Is inflation going to come down? And so on and so forth. So I think these next 6 weeks are really critical. And we as professionals in the real estate industry week after week, really need to be on top of this so we can pick off possibly any direction of what we can anticipate so we can guide our clients on, hey, is it best to strike early in 2024? Should we wait until maybe the middle part where we'll see an anticipated drop in interest rates and possibly a decrease in home pricing? So to me, let's really stick together and analyze these next 6 weeks. They are going to be the most critical for this year. And then the last thing I want to talk about is just worldwide conflict. You know, in 2023, we had so much economic uncertainty that often worldwide turmoil, worldwide conflict just was on the back burner. You know, you look at what happened with Israel, you look at kind of the Middle East and all the things that have been going on. And then just this past weekend, you see that warships are getting hit. We have a base in Iran that's getting hit. And the fact of the matter is, the world is not favorable of the U.S. at times. There's a lot of people that do not like us. And I don't care about your opinion of why. That's not what we're here to talk about. We're here to talk about reality, and that is reality. And the fact is that if somebody attacks us, injures, kills American troops, that can very quickly pull us into a conflict, i.e. war. And during times of war or serious conflict, whether it be domestically or abroad, it just creates angst and uncertainty. That could be something that could really throw a monkey wrench into what the Fed is thinking, how many Fed rate decreases we get, and actually consumer spending and the behavior of the client as we move throughout this 2024 year, and more specifically how it pertains to real estate. Look, in times of uncertainty, people put big ticket items on the back burner. Let's not kid ourselves. And the biggest thing that you're ever going to buy in your life, more than likely, is a home. That's probably for 85-90% of Americans out there. It is your biggest purchase. So let's just hope and pray that somehow, some way, not only can we avoid worldwide conflict, but somehow we figure out to kind of mitigate it so that although it may not happen today, it doesn't happen in 3 months from now. It doesn't happen in 6 months from now. It doesn't happen in a year from now. I think we want to get to a place where we feel fairly comfortable that we're secure and that, we're doing things favorable in the world, so to speak, to make sure that we don't get pulled into some type of war. So that would be the last thing. And, I'm not trying to discourage everybody or end on a negative note, but it is something that I think is out there that could be really disruptive to what economists, traders, the Fed are all thinking, because it's the one thing that unfortunately is really out of our control at times. So, all right, everybody, look, it looks like interest rates, have the potential, I think, this week to make a move in our favor, especially with that jobs report on Friday. I don't anticipate anything but probably a slight decrease as we head into that Fed meeting on Wednesday with the anticipation of what the Fed is already going to say. But again, I really think that jobs report on Friday is the thing that could move the market. So be aware of that and make sure that we're ready to educate our clients on when could potentially be a good time to lock in that rate, should they float, and so on and so forth. All right, everybody, have a great week. As always, I am around. You need anything, phone call, text, whatever, email away. Just shoot me a message, and have a great week. Happy selling out there, and I'll talk to you soon. Cheers.